Is anybody used to this format yet? Is this getting comfortable for anyone, or is this still weird? I'm not quite. I'm not quite yet used to this. Yeah, still weird. I agree. All right. Despite the weirdness, let's uh, let's start with some content. So essentially, we were combining. Let me try to make a graph. We've got some kind of combination of risky assets. We have some asset. We can say one of these is called A, one of these is called B, and this red line represents all the feasible portfolios that represent combinations of A and B. All right, now we have that red line that represents combining things in, risky. That's risky and risky. That red line represents risky, risky. We also talked about last time how there's, whenever you have a combination of a risk-free asset and some other risky asset. So if we have some risk-free asset down here, these axes represent expected returns and then standard deviation of the portfolio. If we combine a risk-free asset which has no standard deviation and some expected return, and we combine that with a risky asset, we talked about how the line that's between those represents a feasible set of portfolios for combinations of risk-free and risky. So these combine the risk-free asset. This blue dot in the south west corner is a risk-free asset. The red dot in the northeast corner is the risky asset, and this blue line represents feasible portfolios, feasible combinations of those two. So we have this red line representing risky, including two risky assets. That's the feasible portfolios of two risky assets. This blue line is a combination of a risk-free asset and a risky asset. And then eventually we can combine those together, where we combine, in this case, we're going to combine the risk-free rate. We're going to combine risk-free with risky. So when we combine the risk-free rate with anything that's feasible, represented by this red frontier that's been traced out on this slide, we can draw a line between the risk-free rate, this blue dot in the southwest corner. We can draw a straight line between that blue dot at any point along this red frontier. We can draw a line between the risk-free rate and any point along this frontier to get the feasible portfolios that represent combinations of the risk-free rate with this risky portfolio. Yeah, so the risky, just that's the on the slides previously we had calculated the expected return and the standard deviation for any combination of portfolios. So this red dot up in the northeast corner, that's all portfolio A. That's 100% A. And then this one down here was 100% B. Both of these are risky assets, and so they have some positive standard deviation and some positive expected return. And you can have, if you have 100% of your portfolio in either A or B, that's going to be associated with some expected return and some volatility or some standard deviation. But we can combine them in any proportion. We can combine our portfolio and split it up in any share to be able to achieve any portfolio along this red line. So the red line just represents the combinations of two risky assets. And it sort of bends backwards. The reason it bends backwards here is because of the diversification effect. There's a risk reduction associated with combining two assets together. Even though both are risky, having them both together in a portfolio can mitigate the overall risk, because as long as they're not perfectly correlated, holding them together means that even if one is going bad, the other one might not be going bad in exactly the same way, and there's some degree of insurance that you're able to get by having a portfolio that's somewhat diversified. So that red line represents the combination of risky and risky. So that's the risky. This line between the blue dot in the southwest corner and the red dot in the northeast corner, that's the feasible portfolios when you combine the risk-free with the risky asset. And then instead of combining the risk-free asset with just a single other risky asset, you can combine the risk-free rate with any combination of two risky assets. So the risky, that's just this red line that's been traced out between these two red dots. And then you can combine that. You can combine any portfolio that's a combination of those two risky assets. We had asset B down here, asset A here. We had the risk. I'm going to call this is the risk-free rate. That's the blue dot. This is the risk-free rate. Right. So that's we're combining RF with B and A in some combination. So given that whenever you combine the risk-free rate with something risky, that implies you can achieve any line or any portfolio that's on the line segment between those two portfolios. We could consider combining the risk-free rate with asset B. In that case, any portfolio along this blue line in the bottom would be feasible. We could achieve any portfolio along that line. Similarly, if we chose a different combination of A and B for our asset that we were going to combine with the risk-free rate, we could achieve any line along this purple line, any portfolio along that purple line. And notice that when we move from, say, any line or any portfolio along the blue line, as we move toward any portfolio along the purple line, we actually are moving. We're actually moving toward the northwest, which is where we want to be. We want to be moving to the northwest. We prefer to have this portfolio be as far up in this northwest corner as we can, where we have high returns and low risk. And so if we can find a way to rotate this curve up as far to the northwest as we can, that's a better position for us. That's giving us more return, and for more return for a given level of risk, or same return with less risk. And then if we just consider the limit of that, we can consider what happens when we push that idea to the limit. We can push this frontier as high as we can. In fact, the portfolio that's going to maximize the slope of this line is going to be a portfolio that's somewhere somewhere right here. It's going to be the portfolio that will maximize the slope of this line originating at the risk-free rate. And so the portfolio for which it's still achievable, it's still lying on this red frontier, but it's also as far to the northwest as possible. That's going to be the frontier that represents the max Sharpe ratio. So the teal dot on that red frontier, that's the portfolio that will push up this set of feasible portfolios as far up into this northwest corner promised land that we're trying to get to. And then notice that because any point along this this teal line is feasible. Any point between the risk-free rate and the risky portfolio is still a feasible portfolio. We're not only able to achieve this teal dot that's along the frontier, we can actually achieve any portfolio that's along the line between the risk-free rate and the and that portfolio that's on the frontier. So that becomes any point along that line then becomes feasible for us as well. All right, so that's sort of the idea of maximizing the Sharpe ratio. We had sort of left off with that idea last class. We can go back to the slides. This is the definition of the Sharpe ratio. It's the RP is the expected return on the portfolio. RF is the risk-free rate, and sigma p is the standard deviation of the portfolio. Now we can, based on our ability to take any combination of risky assets and determine the expected return associated with that portfolio and and compute the variance of that portfolio, which implies the standard deviation of the portfolio. Once we can do that for any portfolio, we can take any combination of our shares in risky stocks, compute the expected return associated with that combination, and then compute the standard deviation of that combination, which gives us everything that we need to know to compute the Sharpe ratio. That is, if we know the risk-free rate, then we have everything we need to know to compute the Sharpe ratio. So we can then take every one of these sets of expected returns and standard deviations, combine them with the risk-free rate according to the Sharpe ratio, and compute the Sharpe ratio for every one of these individual portfolios 1 through 7. So that's the numerical results for the Sharpe ratio. So the maximum Sharpe ratio, we have a maximum Sharpe ratio somewhere around this portfolio 5 with 40% in ExxonMobil and 60% in Solar City. That corresponds to this teal dot. This would be roughly 40% ExxonMobil, 60% Solar City. So that's the maximum Sharpe ratio given those data, and so we can plot that out on this graph. This is just a more a little bit of a tighter version of what I had just sketched out on the virtual whiteboard, but this is this portfolio 5 is roughly the portfolio that will maximize the Sharpe ratio. And that, again, that's because that's the portfolio that allows you to push this line up as far into the northwest corner as you possibly can. Again, the Sharpe ratio for something like a portfolio that was 100% ExxonMobil, the Sharpe ratio would be given by the slope of this yellow line, or this solid yellow line. The Sharpe ratio for a 100% ExxonMobil portfolio is the slope of that yellow line, which is a shallower slope than the slope of the yellow dotted line, which is the maximum Sharpe ratio. So there's a Sharpe ratio that's associated with every portfolio. There's a Sharpe ratio that's associated with every combination of these two stocks. But there's only one that will maximize it, and that happens to be this yellow dotted line. All right, so this gets us to this discussion we've had so far on combinations of two assets with the risk-free rate. We're going to take that next to an analogy to a combination of the risk-free rate with the entire market, not just two assets, not just two risky assets that we can combine in a portfolio. We're going to combine the risk-free rate with a whole portfolio of the entire market, a nice fully diversified portfolio of the market. And we're going to find that there's kind of a similar line, just like there's a Sharpe line, which represents the the maximum Sharpe ratio for any given portfolio of risk-free and risky assets. There's also, we're going to see in a second, there's what's called the capital market line, which represents the line that represents the best you can do if you combine a nice diversified market portfolio with the risk-free rate. One of the key parameters that's associated with that is this beta. Now, beta is like we've been computing the standard deviation of individual stocks. So that's what we did. That's what we were doing when we were looking at graphs like this. We have standard deviation on the x-axis. Again, standard deviation on the x-axis. When we were doing this sort of stuff, we had standard deviation on the x-axis. That was true everywhere. We were plotting standard deviation on the x-axis. What we're going to do next is actually, eventually, we're going to be plotting beta on the x-axis. Now, what beta represents is it's not the standard deviation of the portfolio or the standard deviation of the asset itself. It's a measure of the covariance of that asset relative to the variance of the overall market. It's a measure of, as it says here on the slide, it's a measure of the co-movement between the rate of return on the asset and the rate of return on the market as a whole. So it's some rather than measuring standard deviation, we're going to be measuring variance of the asset relative to a nice diversified market portfolio. So what this beta is going to be formally defined as is the covariance. In this case, we have beta I, which is the beta on asset I. So we have just some asset I. R is going to be the I is going to be the returns on asset I. RM is going to be the returns on the market. And then we're going to do some analysis of those returns, the returns on I as well as the returns on the market, and we're going to compute based on this definition of beta. We have the covariance of the returns on I, the covariance of the returns on I and the returns on the market. So that's the co-movement, the way that the returns on the asset and the way that the market as a whole move. Do those move in opposite directions typically? Do they move in the same direction, but maybe the asset itself moves kind of in a more exaggerated way in the same direction as the market, or does it move kind of in a muffled way where it moves in the same direction as the market generally, but kind of does so in a scaled down fashion? The degree to which the asset is going to move with or against the market is going to represent the extra risk contribution of that portfolio. So this is a key point here. The lower the beta, the lower its risk contribution to a diversified portfolio is going to be. The smaller the beta, if a asset has a small beta, adding that asset to a diversified portfolio is going to not add that much more risk to that portfolio. Whereas adding an asset with a very high beta to a diversified portfolio will overall increase the volatility of that portfolio. So if the beta is actually negative, then adding that asset to a diversified portfolio actually is going to reduce the overall risk of that portfolio, because you're holding an asset that's going to be tending to move upwards when the market as a whole is moving down. So it'll sort of cancel out. It's almost like an insurance policy. An asset with a negative beta is almost like an insurance policy that's going to pay you. It's going to pay out when the market as a whole is down, but you have to pay into it. And so when the market as a whole is up, that asset will actually be down. So it helps to kind of mitigate wild swings in the market by partially canceling out some of those market swings. So you want to think about this beta as being the risk contribution. It's going to be the risk contribution of a particular asset to an already well-diversified market portfolio. So we're going to be, whereas we were looking at standard deviation on the x-axis in the past, coming up here in a second, we're going to be plotting beta on the x-axis rather than standard deviation, sort of to represent the fact that we're going to be assuming that investors are going to be rationally trying to hold a nice portfolio of assets representative of the market as a whole, and then considering, for any particular asset, is any particular asset going to increase the risk of that portfolio slightly, or is it going to decrease the risk of that portfolio? And that will be something that will help to price assets, sort of to represent the equilibrium price of assets. All right, so I summarized that discussion sort of on this slide. So this slide represents things I've sort of already said in words. This will I'll leave this up here and let you guys come back to that. You're free to look at that along on your own. I have the slides up on Canvas, so you can follow along there with slides that are not directly visible on my screen here. So just a simple exercise for computing beta. In this case, we're going to have a world where there's only four possible states of the world. We have four different scenarios: scenario 1, 2, 3, and 4. And we have three investments. One of them is M, the market, sort of a balanced portfolio of the market as a whole. Another one of them is portfolio A, and then another, or sorry, not portfolio A, just individual stock A. And then the other one is individual stock B. And so if we know something about how these assets move up and down in these different states of the world, and we know how the market moves up and down in these different states of the world, then we're able to actually compute the beta according to that formula we had on the other slide, which was you take the covariance of the individual stock and the market, and then you divide that by the variance of the market. That's what beta is going to be. So if we just say look at the individual returns on stock B and consider the individual, and we consider the returns on the market, if each of these scenarios has a 0.25 probability, if each of these a 0.25 probability for each of these, then we can compute the beta. If we just remember that the variance of any random variable x is going to be the expected value of x minus its mean squared. That's the variance. The covariance between x and y is going to be equal to the expected value of x minus its mean times the other asset y minus its mean. Right, so if we just remember those equations, we remember that this probability for each of these scenarios is 0.25. We can use that to compute the covariance of A and B, or sorry, covariance of the market along with stock B. We can divide that by the variance of the market, and if we do that, then we'll get the beta, and it turns out that this beta is negative 1.6. So this asset tends to move in the opposite direction of the market on average, and so holding a stock like this is going to actually reduce the overall volatility of a diversified market portfolio. So yeah, we can go through this quickly. So the expected return on the market, this is the expected return on M. Each of the scenarios was equally likely, so if we can take 0.25 times the individual returns. This is just the definition of the expected value. Just taking each of the individual probabilities of these contingencies and multiplying them by the individual probabilities, multiplying the values under the contingencies times the corresponding probabilities. We do that. This is going to tell you that the expected return on the market is 4%. We can do the same thing with the expected return on B. In that case, we have 0.25 times 17% plus 0.25 times 3% plus 0.25 times 11% plus 0.25 times negative 7%. This is just multiplying each of the individual contingencies, the value under each of these contingencies, just multiplying each of these by a probability of 0.25, since each of these scenarios is equally likely. So that's what we get for expected values. In this case, this is going to be 6% expected return for asset B. Now, if we want to get the covariance of this stuff, we could do covariance between market and B. Again, that's the expected value of the deviation of the product of the deviations between each of these stocks. So that's going to be 0.25 times 7.17 minus 0.06. That's the contingency in scenario 1 times the scenario in the returns in scenario 1 minus the mean returns. That's where this 0.17 minus 0.06 comes from. That's what that is. And then you multiply that times the corresponding value for this other thing. Scenario 1 is also for the market as a whole. It's going to have it's going to be associated with a loss of 3%, and the overall mean returns are 4%. So you subtract the actual value in that contingency of scenario 1 minus the mean value, and then you continue doing that for each of the remaining contingencies. This is going to be 0.03 minus 0.06. And then we do the last scenario has 7% loss for stock B and 11% gain for the market. So this is the way that you compute the covariance. In this case, it's just the values of the returns on B minus the mean of B times the values of return for the market times minus the mean returns on the market, and then each of those is multiplied by the corresponding probabilities. That's the covariance, and then the variance is just going to be variance of the market. It's just going to be each of the individual returns in scenario I minus the average returns. This would be the returns on the market in scenario I minus the average returns, and so you just sum that across all scenarios. Scenario where I is going to be representative of scenario 1, 2, 3, and 4, and then you just take the quotient of that. You take the covariance and you divide it by the variance. That's how you would compute that based on that scenario. Does that help? Does that make sense? So that's where this negative 1.6 comes from. You can yeah, you can verify. I didn't work it all the way out with the variance, but you can verify that for yourself. So yeah, we're about out of time. Where this is leading eventually is we want to be plotting some measure of expected returns where beta is on the x-axis, and there's going to be some risk-free rate and some sort of combination of portfolios that we can mix and match along with the risk-free rate in order to get any sort of return we might want, which would be some combination of the risk-free rate and any other asset. So eventually, this is our goal, is to plot out this line with beta on the x-axis rather than standard deviation, and this represents this line sort of represents the predictions of the capital asset pricing model. And so you can read about that more in the book, and I'll bring this up again on Friday. I think on Friday we're going to have a tutorial for doing regression analysis, where we actually try to take stock data and then estimate what these betas are, and generate this line, this capital asset pricing model line. So I'll teach more about that maybe on Friday, and then we'll go over some ways to estimate that in Excel, and that will be useful for doing your homework 7. So your homework 7 is posted, and that's going to involve using data on stock returns and market returns to get a value for beta for the individual stocks. So yeah, feel free to look ahead to the slides and in reading the book to get it if you want to get a head start on that. But I'll pick up on Friday with just finishing up this CAPM stuff, and then we'll do a tutorial where I'll try to describe how to do a regression in Excel in order to estimate this beta. So are there any questions about anything else I've covered right now before I sign off? Yeah, so Seamus asked a good question about using the sample variance. Absolutely use the sample variance if you don't know exactly what the probabilities of the contingencies are. The key assumption we made in this example is that, let's see. The key assumption we made here is that each scenario is equally likely. And so that was assuming that we already knew what the probabilities are. In that case, we assumed that we knew P. If you're just given data on past returns, you don't actually know P exactly, but instead, if you just have data, then you have to estimate P. You have to estimate how likely it is, how frequently different returns happen. In that case, use sample variance and covariance. So if you have data, then you use the sample variance, sample covariance. But if you know what the probabilities are, then you don't have to use you don't have to estimate the probabilities. You can just go through that process, computing the expected values, like we did here, where you're just multiplying the probability of the event times the outcome of the event. Does that answer your question, Seamus? We divide by n. We divide, yeah. So this is implicitly dividing by n. When we do, this is implicitly dividing by n because we have 4 observations and we're assuming that they're all equally likely. So we're multiplying each by 1/4. But if we use the sample variance, then we divide by n minus 1. N minus 1 would be for the sample variance and sample covariance. That's a good question. Yeah, so that was a population variance. We knew the probabilities. We were assuming that we knew the probabilities. In this case, if it's just estimating those p's, then we're using the sample, and in that case, n minus 1 is in the denominator. If there, yeah, I'm happy to just hang around for a few more minutes if there are any other questions, but we're over time, and so of course you're free to move on if you wish. But I'll be happy to take any further questions on what we just covered now if you're still available and want to chat.